No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. All right, we're going to be talking investing today, right? With the markets doing what the markets are doing, this is a big concern. Well, let me bring a little bit of perspective into this. If we look at the S&P 500 index over the last, let's say in 2017, it ended up about almost 22%. All right, so that's a pretty good year for the market. Then we started out this year. Now, since when you're looking at the financial reports, if you're looking at any of the financial shows, one of the things they're talking about is how much the market being off about 10% or a little over 10% in correction territory. And they're talking about the highs that it hit in January. All right, if we look at it actually year to date, it's off maybe about, I think, close to 4%, we'll say, for the year. And who knows what we're going to be seeing today with the volatility you have. And that's the biggest thing and the scariest thing is seeing these huge swings where you can be up 500 on the Dow, 500, 600 points one moment and then end up 500 or 600 points down when the market closes, or even 1,000 points down that we're seeing as well. So we're seeing a huge amount of volatility, these ups and downs, and that makes everyone a little nervous. So we have to put that in perspective as far as that long-term investing goes. When we're looking long-term, we're not worrying about days and weeks. As long as we have the correct asset allocation in our models, as long as we have the correct investment plan, then we're not going to have to worry. When I'm meeting with clients and we're doing reviews, for instance, one of the things we're looking at is how are we doing relative to your financial plan that we've put together from the beginning? Are we still on track? Are we worried as far as a correction or even a bear market? Are we going to be able to weather that and still maintain the amount of income needed to maintain your standard living quality of life, right? Those are the things we're most concerned about. It's about income, all right? These fluctuations, if you've got the proper asset allocation, one, you're not going to be seeing as big, this big volatility, all right? That's one of the things with the market. If a properly put together portfolio, all right, will have the ability. So an example would be, if you look, and I'm going to revisit, by the way, I've talked about investing here many times, in the story of investing and how to reduce volatility, and I've talked about the works of Dr. Markowitz, who won the Nobel Prize in 1990, Dr. P.1a in 2013. We have a science of investing. We have a lot of data that we can use in putting together portfolios to reduce this type of volatility, all right, so that we can weather these kinds of things without concern, and that it's not going to impact your lifestyle. And I'm going to show you some things on that as well, and the importance of sequence of return, about when you're retiring. So if you're at or near retirement right now, if you're thinking, oh my goodness, it's just a few years out, and with this kind of volatility, we're down 10% on the highs, is that are we going to maybe continue on? Is it going to be a bear market? Normally we wouldn't see a bear market in this type of economic environment, but hey, no one's got a crystal ball. Who knows what could happen? Again, the issue is making sure you're properly allocated. Now, here's the other part of that. As I was talking about earlier, one of the things here is when if you look at the S&P 500, if you look at the market, from 2000 through 2002, the market dropped about 45%. And yet a moderate portfolio, 60-40, let's say, stocks and bonds, over that same time frame was basically at about a break even. In other words, it lost maybe let's say on $500,000, it may have lost $2,000 or $3,000. Okay, it was like very, very small difference. Which meant the next year, right? This was from 2000 through 2002. 2003, it was making money, where it took the market about 5 more years to recover from that bear market. So your total time, or about 4, it was the total time from the beginning of 2000 to get back to where you were looking at the S&P 500 index. It was about a 7-year period. Okay, now keep in mind, you could have bought an S&P 500 index fund, right? I've talked about that before. The S&P 500 index outperforms 90% of actively managed equity mutual funds, or not of all equity managed mutual funds. So think about that. The S&P 500 index is going to outperform. However, you've got that volatility. So now let's put together, again, going back to that 60-40 portfolio, when again, a properly allocated, all right, and diversified portfolio, and I'm going to share with you some of that research so you can see how that works. And it's the same portfolios that I invest in and that my clients invest in, where this type of portfolio helps minimize that volatility. All right, so when we're looking at, and yet still maintain the type of return that we're looking for. All right, so that's the other piece. So let's say, for instance, over that period, if we look at the S&P 500 index, all right, now we'll go forward from the next bear market, 2007, October of 07 to March of 09, the market dropped 55%. Huge drop. All right, well, what happened with the portfolios there? Now we took a little bit more of a hit, but still much less so. Over that period, it was about a 20 to 25% drop on that 60-40, about 20%, excuse me, on that 60-40 portfolio. So again, about less than half of what the market did. And here's the other part. It recovered so much faster. So it took, from that time, it took until 2012, about 5 years to recover from that bear market, or to get back to where you were at the beginning, let's say in the, would have been the end of the third quarter in 07. To get back to that point took about 5 years. If you were invested in the S&P 500 index, all right, that fund, and keep in mind, it outperformed 9% of equity mutual funds, which meant most investors took a lot longer to recover than just that 5 years. Here's the other part. That portfolio I mentioned, the 60-40, it recovered in less than 2. Okay, so that's the other piece of what. If your portfolio right now is going all over the place in terms of volatility, even if it's doing as bad as the market, or or maybe even worse, of course, then this is a time to maybe revisit that asset allocation. And this is the other part. Not everything recovers the same way. So if you think about how you're invested currently, one of the big myths out there, this fallacy, and the way that this is promoted, is that your advisor may say, oh, you just need to stay invested. Well, yes, I'm not saying you should get out of the market. In fact, definitely not. But I would revisit how I'm invested in the market. Like I said, what did I just say about the recovery period? Okay, so is this a good time for me to position myself better so that I will recover faster from a volatile period such as this? Or that I'll be able to weather whatever may yet be to come, because we don't know that we're certainly not out of it yet, are we? All right, and where this is going to be, the typical, by the way, typical correction of over 10%, which is the definition of a correction, it takes about 4 to 6 months to recover from that period. That's historically typical, right? So we're saying these are the averages. Who knows what this next year may hold for us? No one does, all right? What we do know then is that we want to be positioned in such a way that whatever it does, we're going to be able, we're going to be good. If the market goes up, we're going to benefit tremendously from that. If the market goes down, we're going to protect that downside. And there's some other strategies I'm going to share with you on that as well. So we're going to kind of revisit some basics. We'll start with the 3 worlds of investing. We'll get into things about the market in terms of how how portfolios are designed. We'll talk a little bit more about the academic approach, if you will, the academic research that we have and how we can put together portfolios. So we're going to get into all that to help you better position yourself so that you're not going to have to worry through these volatile times. You, in fact, are going to weather that great. All right, you're going to do fine with your portfolios. You're going to be positioned in such a way that you're going to be able to maintain your standard of living, quality of life, no matter what happens. Okay, that's what we want to do, right? All right, but first we're going to take a break, and when we come back, we're going to jump into this. So join me here. We'll be right back on the Retirement Report.
This is